Qutub says Tesla closed around 671XX. Okay, we've got it at 671.87. So Qutub is asking, if I buy 100 Tesla and sell one contract June 17th, 2021, 680 call for $151 in premium, it will give me a 22% return. And he asks, is that a good strategy since I don't have to worry about it for at least a year? Now, the first thing I want to bring up here is I'm going to show you something. A follow-up question that we'll get to Qutub later on after we discuss this. Qutub says, second question, how can I find stock with the same volatility that Tesla has? Keep in mind, Tesla is not that volatile. It's a high-priced stock, and that's why the premiums are high. But the stock volatility is only at 44 for the 50-day and only 40% volatility for 20 days. Now, the 100-day is 60. That's pretty high. The 250 is 72. But a lot of stocks are like that. So while I'm here, before we get into the analysis of your covered call, what we might call a simulated CD covered call as well. So let's just write this down, 40, 60, and 72. I want to take a quick look at something. On Power Options in the Learning Center field under the Home tab, there's some useful information here. Of course, there's a lot of it. Archives for the emails that are sent in the morning. And we want to look at market activity. And the market activity, we can look at basic market statistics, 52-week highs and lows. I want to click on optionable stock statistics. The optional stock statistics page shows us the average of various stock and option criteria across all optionable stocks in ETFs. The average stock price for all optionable stocks is $62.87. Average option bid price is $31.70, but the lowest is 1, the highest is 2,500. But I want to go down here to the volatility. The average implied volatility, the 20-day volatility across the market is 0.36, meaning Tesla is just a little bit above the average. The 50-day is 0.40, is the average across all optionable stocks, indexes, and ETFs. Tesla is just 4% above that. Now, Tesla's 100-day, because we know it does get wild from time to time, is at 60. Okay, that would be considered slightly higher, but there are some stocks, Qutub, that are in the 70s, 80s, 90s, 100% volatility. And of course, the 250 average across the entire market is only 47%, and Tesla was 72. So over the year, it's been more volatile. But in the last 50 days, 2 months, it's been on par with the rest of the market and not overly volatile. But in a moment, we're going to share with you exactly how you can find stocks with similar volatility to Tesla or any other position you're looking for. First, let's build your planned position. 100 shares of Tesla at current market price. There, let's put in 100 shares. We want to go a year out to June. No, that's 2 years out. My apologies. We're going to go a year out to June 2022. And let me just do this real quick so you guys don't have to watch all the scrolling here. We were talking about the 680, if I'm not mistaken, slightly at, this is the at the money call. Okay, that's fine. All right, and we're going to sell one contract of the 680. So let's submit that, see what we've got. Okay, with the current prices using the midpoint, Qutub of 152.45, what you're seeing is I'm seeing a 30.9% return instead of the 22. Okay, what's important here is the downside protection, meaning that you've got roughly the same amount of downside protection in this case because you're selling sort of at the money. And how far the stock can fall before you're losing money on the position, it's about 150. So you get a little bit of increase here for that increased return at the 680 strike, I believe you said. Yeah, 680 strike for June out there in time in that case. And we have a reasonable downside protection. Is this a reasonable trade? Well, we do something similar, in fact. And in the covered call search, we have what we call here simulated CDs. Okay, And what we're looking for are covered calls that are slightly in the money, that are a year out in time, that offer at least, an annualized return of 7%. Okay, well, that's good. We're well within those ranges here. But looking for similar numbers, a 20, 22% maybe return if assigned, and still keeping a 20 to 30% downside protection. This is not something we do personally, but that doesn't mean it's a bad strategy. It's a good strategy to use, and these are some good examples of similar positions. I mean, here's one on AMD going out to year and a half out to January 2023. We are seeing a 28% downside protection, only a 15% return because it's going slightly in the money. Flex Limited is about the same, a year and a half out, 22% return, 31% downside protection. So these are just other ideas in those cases. Who is this? Who does this? There are people who do this. Who does this? Number one, I have several Power Options subscribers that do it for the reason that they don't want to be bothered with rolling up or rolling down a covered call every week or every month as the stock has the little fluctuations in price. As we know, you will always get a higher annualized return if you sell month by month by month. But if you find positions that match your target for minimum return with a reasonable probability of getting assigned and getting that return in 450 days, 1 year out in time, a year and a half out in time, maybe even less, 210 days, 11.5% return with a 28% downside protection. This is a strategy to use. Financial advisors will use this strategy for their clients. Why? Well, I'm not a financial advisor. I don't have any money that I manage, but let's say I had 10 clients. They all had a fair amount of money and they all want to do options. And so they came to me because I'm an options financial advisor. What is the easiest thing for me to do to show those customers that I can give them diversification? I can bring in 10 to 20% of premium right now and still guarantee the potential that they won't lose any money unless the stock falls 30%. And you'll still get about 12 to 13% return down the road, or 20% return in a year. I can take 5 positions for each of those 10 customers. That's 50 positions. Do the sort of in the money covered call far out in time that we're looking at. And now I don't have to touch those portfolios until the next maybe 4 months. Maybe one has a bad earnings in the next quarter, so maybe I make an adjustment, or I don't because I'm still within my ranges. It's hands off, an idea to give you some safety with still getting a good return over time and not having to worry about watching the position and rolling it at month by month by month. I'm not going to use Tesla, but it's going to be the same exact structure. I want to go here. I'm going to go to Corsair, CRSR. I'm going to clear the filters out. I'm sorry, the Corsair is the September 27.5, 448 days out in time. And where's my in the money? Okay, it's 18% in the money to give an annualized return of 19.5% with a 34.5% downside protection. Okay, so what I want to do, I cleared the filters. I'm going to set all expirations. And the percent in the money, we're going to go 17 to 20. That's the only filter I'm going to use. And we're going to go to fundamentals. I'm sorry, CRSR. Now, the numbers for Tesla would be very similar, Qutub, in this case, but this is what I wanted to show you. Okay. All right, we'll scratch the July 16th one doesn't have any time value or any return here. But you see here that those farther out options do give us the relatively highest percent if assigned annualized. However, in this case, it looks like the December is actually giving us the best annualized return, even though it's 9.7%, and we're still getting a 26% downside protection. Now, it's equal to February in this case. Normally, it's a little bit more range. Let me try another stock very quickly. I'll try Tesla. Let's see what we've got. Remember, this is in the money, Qutub, not exactly your out of the money out of the money 680 strike that you mentioned on TSLA. But we're just going to change it. I'm going to stay in the money. Okay. This is, yeah, CSRS is very, very odd, isn't it? And we've got, 17 pages to go here. In this case, let me just do year one out of the money. I'm sorry, that would be easier. Should grab me the 680 strike. Perfect. 675's crept in there too. This is perfect. Do you see that column there, Qutub? Percent if assigned annual at midpoint. So we were talking about our June call here, 357 days away, 1 year as you mentioned, with 31.6% annualized potential return, 22.7% downside protection. Now, I just wanted this to illustrate, I don't know why CRSR was so weird. This is what you typically see when you look at any option chain. You know this, Qutub, but this is just a look at. If I just kept selling the at the money 672.5, for example, that's available. That's why we're seeing different strikes, because there's not those lower strikes further out in time. But in this case, the at the money going month by month would give an 87% return. And a year from now would be only at 31.6, selling the farther out. If we went all the way to 2 years out in time, 3 years out in time to 2023, 2.5 years, of course. I'm sorry, that'd be, January 2000. That's the June. That's 2 years out in time. It's only a 27% annualized return. Get a heck of a lot more downside protection, don't you? And that's a good thing. Don't get me wrong. But again, who uses this? Well, we sort of already explained that. It's used for investors that don't want to follow the stock too much. They don't want to have to feel they have to roll the position month by month by month or week by week by week. Or maybe a financial advisor who wants to show their clients income coming in now on their quality stocks that likely also pay a dividend. They can tell them that, hey, your stock can't lose money. Even if it falls 22%, you're still going to be at a small profit because of the downside protection. And at the same time, they don't have to do any management. They may only have to check those 5 positions once a quarter, maybe not even, maybe just every 6 months. Or if they want to adjust it, they can roll it out further for more premium at that time. It's not a bad strategy. It's similar, to that simulated CD search we have on Power Options there as well. But again, you are going in knowing that you're lowering that annualized percentage return compared to if you kept month by month or, of course, week by week in those situations. The weeklies, of course, are on the next page. That's why it's just going us to 28 days out, the standard July expiration. Now, before we go any further, I'm going to point you in the direction of something Qutub. We're going to go to Power Options here. We're going to go to YouTube. And I'm going to search my videos real quick for covered calls. And try to find the one very quickly, and then we'll get to Kevin's question. Okay. Yep, here it is. It's titled A Covered Call Approach, Far Out in Time, High Return and High Protection. So this is a 20-minute discussion. I don't think we reached 20 minutes here. We might have. Actually, about 17. It's 15 minutes so far. But that's a similar discussion that goes more into what that simulated CD search is, how we might use it, the advantages and disadvantages of it as well, Qutub in that case. Okay, so let's go back to Power Options real quick. I'm sorry. And I'm going to, oh, shoot. I'm sorry, folks. I'm going to go back to that simulated CD search. But what we're going to do here is I'm going to go at least 300 days out in time. So we're looking for a covered call, Qutub. You asked about how we can find similar positions, similar volatile positions for Tesla. So I'm going to go all expirations, but force it to be 300 days or more. We were looking at about a annualized return of 20%, and I want a downside protection of at least 30%. And Oh, I didn't clear out all the filters. I'm sorry. Let me clear out all the filters there. There we go. Now I'll put my numbers in. Incentive assigned annual of 20%, downside protection of 30%. Similar to the positions we saw in the simulated CD. Now, Tesla is a higher price stock, of course. And, yeah, we want some volume today. And we're going to restrict it to just, again, that one strike out of the money Qutub. That's how to use the search tool. And we saw what the 20-day and the 50-day volatility was. The 50-day volatility was at 0.44. It's been moving with the market. So for the stock volatility, I'm just going to put stocks at 0.40 to 0.48. Now, once I saw the Tesla's volatility, I'm just going to target that volatility similar to that stock with the similar returns that Tesla had for your near 1 year out position. I might restrict the days. Actually, we'll go less than 400, so we keep it if there's anything in that 357-day range with a similar volatility. It's a very tight restrictive search. If you think about it, let's just go 400. Okay? And let's just submit it. No, okay. So downside protection might not have been as high as I wanted. Option volume today. Oh, let's take that out. I'm sorry. I don't need the option volume today if I'm just looking one strike out of the money. Okay. I'm sorry. I thought Tesla had that 30% downside protection I was looking for. Okay, there you go. The Ultra QQQ, 117.50, selling the June 120. This is what I meant by it's too restrictive because only a few are going to have that June expiration. It's a fair amount of stocks, but all three positions have the 20% downside protection I was looking for and at least that 30% return if assigned at midpoint. You've got Surgery Partners at 67.05, the June 70 at 11.60, and Tesla there as well. Let's drop this down to 280. And we'll go up to 550, so that will take us out to January as well. We're going to get a lot more results with this wider search here. So Power Fleet is 539 days out in time, 41% downside protection, 51.2% annualized return. Stocks at 727 though. That might be, yeah, I'd probably look for stocks greater than $15 in this. I didn't do that. Zillow's in there out to September of 2022. 23.5% downside protection, 32.3% return if assigned. There's Surgery Partners, there's Tesla. A different Zillow. I'm not sure. I'm going to have to take a look and see what that difference is. The Zillow groups. And then Winnebago is an interesting one, isn't it? That one's got about a 22% return for 511 days. It's only 21.5% annualized return. These are all positions that have similar volatility to Tesla in the last 50 days. Now, if you wanted to look for something that was more volatile, as Tesla was, their 250-day volatility we saw was at 72% rather than 44%. Just change that historical volatility to a range you want to be higher in that case. You'll get more premium, if I'm up in the 50, 60 range and a higher downside protection. Anytime you want to find a stock that says, hey, I want to find stocks similar to this position I saw on the stock I'm tracking. Well, just use the search tool to target your position that you wanted with the return and the downside protection ranges, minimum requirements you're looking for, and then just look for that same expiration time frame. And for you were looking one strike out of the money. On the simulated CDs to be about 2 strikes in the money, potentially more, depending on the individual stock. All right, so now we've gone a full range longer than that other discussion that we had on the covered call approach, but you should check that out, Qutub, as well. I give you something to watch on the weekend until I can get your presentation posted.